Warren Buffett, the most successful investor in history, credits one book with shaping his investment philosophy and making him billions of dollars. He calls it, by far, the best book about investing ever written. That book is The Intelligent Investor by Benjamin Graham, first published in 1949, but as relevant today as it was 75 years ago. Today, we're diving into this legendary investing classic that has guided generations of successful investors. Graham wasn't just a theorist. He was a highly successful investor himself, who developed and refined these principles through decades of actual market experience, including surviving the 1929 crash and Great Depression. What makes this book timeless is that Graham doesn't focus on predicting markets or finding hot stocks. Instead, he teaches you how to think about investing, how to analyze value, manage risk, control emotions, and structure your approach to maximize long-term success regardless of what markets do. These principles work in bull markets, bear markets, and everything in between. Graham distinguishes between two types of market participants: investors and speculators. Speculators try to predict short-term price movements and profit from market psychology. Investors analyze businesses, buy them at prices below their intrinsic value, and profit from the long-term growth of those businesses. Graham is teaching you to be an investor, not a speculator. The book's central concept is the margin of safety, buying securities at prices significantly below what they're actually worth. This single principle, properly applied, protects you from major losses while positioning you for substantial gains. It sounds simple, but as we'll see, applying it requires discipline, patience, and emotional control that most people lack. Over the next 20 minutes, we'll explore Graham's complete investment philosophy, the difference between investing and speculation, how to analyze a company's true value, the concept of Mr. Market and managing emotions, defensive versus enterprising investor strategies, the critical importance of margin of safety, and how to build a portfolio that survives any market condition. By the end, you'll understand why this book has created more successful investors than any other. If you've ever lost money in the stock market, if you're confused by conflicting investment advice, or if you want to build lasting wealth through intelligent investing rather than gambling, these timeless principles are exactly what you need. Let's discover what the intelligent investor knows that everyone else doesn't. Chapter 1. Investment versus Speculation. Graham opens with what he considers the most important distinction in finance: the difference between investment and speculation. Most people who think they're investing are actually speculating without realizing it, which explains why they consistently lose money or achieve mediocre returns. Graham defines investment as an operation which, upon thorough analysis, promises safety of principal and an adequate return. Every word in this definition matters. An investment requires thorough analysis, not tips, hunches, or predictions. It promises safety of principal. You're not likely to lose your money, and it provides an adequate return. You're being compensated fairly for your risk and time. Speculation, in contrast, is buying something hoping it will go up in price without rigorous analysis of its underlying value. When you buy a stock because it's been rising, because everyone's talking about it, or because you think you can sell it to someone else at a higher price, that's speculation. When you buy cryptocurrency hoping it will moon, that's speculation. When you day trade based on chart patterns, that's speculation. Graham doesn't condemn speculation. He acknowledges some people enjoy it and can make money at it. But he insists you must know which you're doing. The worst mistake is thinking you're investing when you're actually speculating. That's when people risk money they can't afford to lose or base their retirement on speculation disguised as investment. The author provides clear markers of speculation: buying without understanding the underlying business, buying primarily because the price has been rising, buying on margin, borrowed money, buying based on predictions about what the market will do, or buying anything you couldn't hold comfortably for 5 years. If any of these describe your approach, you're speculating. Graham explains that speculation is a zero-sum game minus costs. For every person who profits from short-term price movements, someone else loses. After accounting for transaction costs and taxes, speculators as a group lose money. Investment, in contrast, is a positive-sum game. When you own profitable businesses, you participate in wealth creation through their earnings and growth. Everyone can win. The book emphasizes that market prices fluctuate constantly, and most of this fluctuation is speculation-driven noise rather than changes in underlying business value. An intelligent investor recognizes this and uses price fluctuations created by speculators as opportunities to buy value at a discount or sell at a premium. A speculator is whipsawed by these same fluctuations, buying high when excitement peaks and selling low when fear dominates. Graham shares historical examples of speculation gone wrong. The 1920s stock market bubble, where people borrowed heavily to buy stocks that were already drastically overvalued. The subsequent crash wiped out speculators, while intelligent investors who'd maintained margin of safety and portfolio discipline survived and thrived. These patterns repeat throughout history. Tulip mania, dot-com bubble, housing crisis, cryptocurrency bubbles. Because human nature doesn't change, the author provides a self-assessment. Answer honestly whether you're investing or speculating in each of your holdings. Do you understand the business? Have you analyzed its value? Did you buy it at a price below that value? Could you hold it for 5 years without worry? If you can't answer yes to all of these, you're speculating. And Graham suggests you either do the analysis to convert it to investment, or acknowledge it as speculation and limit it to a small percentage of your portfolio that you can afford to lose. One powerful insight Graham offers: the stock market's primary function isn't predicting the future or establishing correct prices. Its function is providing liquidity, allowing you to buy or sell ownership stakes when you choose. The intelligent investor uses this liquidity as a tool, buying when others are selling in fear and selling when others are buying in greed. The speculator is controlled by price movements, and liquidity becomes his master rather than his servant. Chapter 2. Mr. Market and the Investor's Emotions. Graham introduces one of the most famous and valuable metaphors in investing: Mr. Market. This concept alone is worth the price of the book, as it transforms how you think about stock price fluctuations and protects you from costly emotional mistakes. Imagine you own a share of a business, and every day a person named Mr. Market shows up offering to buy your share or sell you his share. Some days Mr. Market is euphoric and offers very high prices. Other days he's depressed and offers very low prices. The key insight: you don't have to accept his offer. You can ignore him entirely, deal with him only when it suits you, or simply hold your shares and enjoy the profits the business generates. This is exactly how the stock market works. The daily price quotes are Mr. Market's offers, and they reflect his mood swings, sometimes optimistic, sometimes pessimistic, often irrational. An intelligent investor treats these quotes as opportunities to exploit, not instructions to follow. When Mr. Market offers ridiculously low prices in his pessimism, the intelligent investor buys. When he offers absurdly high prices in his euphoria, the intelligent investor sells. Graham emphasizes that this is the opposite of how most people behave. Most investors let Mr. Market's moods control them. When Mr. Market is excited and prices are high, they feel confident and buy. When Mr. Market is depressed and prices are low, they feel fearful and sell. This guarantee buying high and selling low, the path to losing money. The author explains that the market's greatest gift to intelligent investors is its irrationality. If markets were perfectly rational and always priced securities correctly, there would be no opportunity for superior returns. The fact that markets swing between irrational pessimism and irrational optimism creates opportunities to buy dollars for 50 cents and sell them for $1.50. Graham provides guidance on managing your relationship with Mr. Market. First, never ask Mr. Market for advice. Don't let price movements influence your assessment of value. If you thought a business was worth $100 per share based on thorough analysis, and Mr. Market offers $70 tomorrow, the business hasn't changed. Only Mr. Market's mood has changed. Either your analysis was wrong, in which case revise it, or Mr. Market is creating a buying opportunity. Second, use Mr. Market to your advantage, but don't depend on him. When you invest, assume you won't be able to sell for several years. If you're only willing to own something as long as you can sell it quickly, you're not investing. You're speculating on Mr. Market's moods. Third, remember that Mr. Market is there to serve you, not to guide you. You don't need to trade with him every day or even every year. You can ignore him for extended periods and only engage when his offers are compelling. Graham addresses the psychological challenges of this approach. It requires emotional discipline to buy when everything looks terrible and everyone is pessimistic. It requires confidence to stand apart from the crowd. It requires patience to wait for Mr. Market's extremes rather than reacting to every wiggle. Most people can't do this, which is why most people achieve mediocre investment returns despite the market's long-term upward trajectory. The author shares historical examples of Mr. Market's mood swings. In the Great Depression, Mr. Market offered shares of excellent businesses at fractions of their liquidation value. You could buy companies for less than their cash in the bank. Intelligent investors who bought during this panic earned extraordinary returns. In the late 1990s dot-com bubble, Mr. Market offered astronomical prices for companies with no earnings and questionable business models. Intelligent investors who sold or avoided these stocks protected themselves from devastating losses. One crucial point Graham makes: Mr. Market's mood swings are not symmetrical in their consequences. Buying during euphoria when prices are high can cause permanent capital loss if prices don't return to those levels. Buying during depression when prices are low provides protection. Even if you're slightly early and prices fall further, you've bought actual value that will eventually be recognized. Graham introduces the concept of temperament as more important than intellect for investment success. You don't need to be brilliant to be a successful investor, but you do need emotional stability and discipline. The ability to remain rational when others are panicking, or euphoric to act independently of the crowd, and to focus on value rather than price movements. These temperamental qualities determine success far more than intelligence or market knowledge. The chapter concludes with Graham's advice. Cultivate indifference to Mr. Market's daily, weekly, and even monthly moods. Check prices infrequently. Focus your energy on analyzing businesses rather than predicting markets. Develop the confidence to act against the crowd when your analysis shows opportunity. And remember that the market exists to serve you, not to instruct you. This mental framework, treating Mr. Market as a useful servant rather than a wise guide, is foundational to intelligent investing. Chapter 3. The Defensive Investor Strategy. Graham divides investors into two categories, defensive and enterprising. The defensive investor prioritizes minimizing effort and avoiding serious mistakes over maximizing returns. This isn't a criticism. Graham respects this approach and argues it's appropriate for most people who have careers and interests outside of investing. The defensive investor's goal is to achieve satisfactory results with minimal time and effort. Graham defines satisfactory as returns reasonably close to the overall market average with minimal risk of serious loss. This might sound unambitious, but Graham points out that most professionals fail to achieve even this standard. So, it's actually an admirable target. Graham provides specific rules for the defensive investor. First, adequate diversification. Own at least 10 different stocks across different industries. This eliminates company-specific risk without requiring extensive research on hundreds of companies. Second, stick to large, established companies with long track records. Graham recommends companies that have paid dividends for at least 20 years. These businesses have proven they can survive various economic conditions. They're not exciting, but they're stable, which is exactly what defensive investors want. Third, maintain a balance between stocks and bonds. Graham suggests never having less than 25% or more than 75% in stocks, with 50-50 as a reasonable default. The exact allocation depends on market conditions and personal circumstances, but the key is balance. When stocks become expensive, shift toward bonds. When stocks become cheap, shift toward stocks. This systematic approach prevents getting caught up in market extremes. Fourth, buy stocks only at reasonable price-to-earnings ratios. Graham suggests defensive investors shouldn't pay more than 25 times recent earnings for stocks. This rule automatically prevents buying into bubbles when everything is overpriced. Fifth, require adequate asset backing. Graham recommends stocks trading at less than 1.5 times book value, ensuring you're not paying excessive amounts for intangible optimism about the future. Graham emphasizes that following these rules requires discipline, but minimal time. A defensive investor might review their portfolio once or twice a year, rebalance if necessary, and otherwise ignore market fluctuations. They're not trying to beat the market. They're trying to capture market returns without falling victim to speculation, fraud, or panic. The author addresses index funds, which didn't exist when the book was first written, but which Graham would certainly endorse. Low-cost index funds that track the overall market are perfect for defensive investors. They provide instant diversification, require no company analysis, charge minimal fees, and deliver market returns. Graham would argue that the defensive investor who simply buys low-cost index funds and maintains an appropriate stock-bond balance is following a sound strategy. One of Graham's key insights for defensive investors: the biggest risk isn't missing out on spectacular gains. It's suffering serious losses that damage your financial security. The defensive approach protects against devastating mistakes, buying overvalued stocks, concentrating in one sector, following hot tips, or panicking during crashes. By following simple, time-tested rules, defensive investors avoid these pitfalls. Graham also addresses what defensive investors should avoid. Don't buy new issues or IPOs. You're competing against professionals with better information, and the odds are against you. Don't buy based on analyst recommendations. Their incentives aren't aligned with yours. Don't buy companies without earnings hoping for future profitability. That's speculation. Don't buy on margin. That converts investment into speculation by adding leverage. The chapter concludes with Graham's observation that the defensive approach, while unglamorous, has historically produced satisfactory results for those who follow it consistently. Many defensive investors outperform enterprising investors who spend far more time and energy trying to beat the market, but make costly mistakes along the way. Sometimes the best strategy is the one you can actually execute consistently, and the defensive approach offers that advantage. Chapter 4. The Enterprising Investor Strategy. The enterprising investor is willing to devote time and effort to achieving better-than-average results. Graham is clear. This approach is only appropriate if you're genuinely interested in investing, willing to study businesses thoroughly, and have the temperament to act independently. If these don't describe you, stick with the defensive approach. Graham's first message to enterprising investors might surprise you. It's harder than you think to outperform the market, and you shouldn't expect spectacular results. The enterprising investor who achieves 3 to 5 percentage points per year above market returns through intelligent security selection is doing exceptionally well. Anyone promising or expecting much more is likely headed for disappointment or taking excessive risk. The enterprising investor's edge comes from thorough analysis and willingness to act when opportunities appear. Graham identifies several hunting grounds for these opportunities. First, large companies that are temporarily unpopular. These stocks get hammered when they face short-term problems. But if the underlying business remains strong, they represent excellent value. The enterprising investor has the patience to buy when everyone else is selling and wait for the market to recognize the value. Second, secondary companies that are ignored by analysts and institutions. These aren't famous household names, so they receive less attention. When they trade at low valuations relative to earnings or assets, they can offer substantial returns. Graham recommends focusing on profitable companies with strong balance sheets, trading at bargain prices due to neglect rather than fundamental problems. Third, special situations like reorganizations, liquidations, or spin-offs. These corporate events can create temporary mispricings as securities change hands and ownership structures shift. The enterprising investor who understands what's happening can profit from the confusion. Graham provides detailed criteria for stock selection by enterprising investors. The company should have adequate size, at least 100 million in annual sales to ensure stability. Financial condition should be strong. Current assets at least twice current liabilities, and long-term debt not exceeding working capital. Earnings stability, some profit in each of the past 10 years. Dividend record, at least some dividends paid currently. Earnings growth, at least 1/3 increase in per-share earnings in the past 10 years. Moderate price-to-earnings ratio, not more than 15 times recent earnings. Moderate price-to-assets ratio, not more than 1.5 times book value. These criteria are conservative by design. Graham isn't looking for the next Amazon or Apple. He's looking for solid businesses trading at genuine bargains. He'd rather miss opportunities than take excessive risk, which is why his approach protects capital even when it means missing some winners. The author emphasizes that enterprising investing requires substantial work. You must read annual reports, analyze financial statements, understand industry dynamics, and assess management quality. You must develop the ability to estimate a business's intrinsic value independently of its market price. And you must have the emotional fortitude to act when your analysis differs from market consensus. Graham also warns about what doesn't work. Simply trying to predict which industries will grow fastest rarely succeeds. Everyone has access to the same information, so anticipated growth is already reflected in prices. Trying to time the market by predicting short-term movements is equally futile. Following tips or recommendations without independent analysis is delegation, not enterprising investing. One approach Graham particularly recommends is buying companies trading below net current asset value, where the stock price is less than current assets minus all liabilities. This means you're buying the business for less than it could raise by liquidating its current assets alone, without assigning any value to fixed assets or the ongoing business. These situations are rare, but offer exceptional safety and return potential. The author acknowledges that enterprising investing today is more challenging than in his era because markets are more efficient and information is widely available. The day when you could consistently find major companies trading at obvious bargains has passed. But opportunities still exist for those willing to look in overlooked places, small companies, international markets, complex situations that others avoid. Graham's advice to enterprising investors: be patient and selective. You don't need to be active constantly. Wait for genuine opportunities that meet your criteria rather than forcing mediocre investments. Hold cash when nothing compelling is available, and accept that periods of inactivity are part of the process. You're not paid to be active. You're paid to be right. The chapter concludes with a warning. If you try the enterprising approach and find yourself consistently underperforming the market or making emotional decisions during volatility, admit that it's not working and switch to the defensive approach. There's no shame in this. Graham argues most people should be defensive investors, and attempting enterprising investing when you lack the temperament for it is a recipe for poor results. Chapter 5. Margin of Safety, the Central Concept. Graham considers margin of safety the central concept of investment, the principle that ties everything together and provides the foundation for intelligent investing. This isn't just an important idea, it's the master key that unlocks successful investing. Margin of safety means buying securities at prices sufficiently below their intrinsic value to allow for errors in analysis, bad luck, or normal business fluctuations without suffering serious loss. It's the buffer that protects you when things go wrong, and they inevitably will go wrong sometimes. Graham uses an engineering analogy. When engineers design a bridge to carry 10,000 pounds, they don't build it to support exactly 10,000 pounds. They build it to support 30,000 pounds. The extra capacity is margin of safety, ensuring the bridge doesn't collapse if calculations are slightly off or conditions are worse than expected. The same principle applies to investing. If you calculate a stock's intrinsic value as $100 per share, you shouldn't buy at $98. That's not margin of safety. That's hope that your calculation is perfect. You should buy at $60 or $70, creating a 30 to 40% buffer. This margin protects you if your analysis was too optimistic, if business conditions deteriorate, or if Mr. Market stays irrational longer than expected. Graham explains that margin of safety is what transforms speculation into investment. A speculator buys something at full price, hoping it goes up. An investor buys something at a significant discount to value, ensuring profit is built, regardless of what the market does. The market might recognize the value tomorrow, next year, or in 5 years. But eventually, value tends to be recognized, and the margin of safety ensures you profit even if recognition takes longer than expected. The author provides examples of margin of safety in action. During the Great Depression, excellent businesses traded at fractions of their liquidation value. An investor buying at those prices had enormous margin of safety. Even if business conditions worsened further, the stocks were so cheap that serious loss was unlikely. When the economy recovered, these investments generated spectacular returns, but the key is they were safe even if recovery took longer than expected. Graham emphasizes that margin of safety is quantitative, not qualitative. It's not about buying quality companies at fair prices. It's about buying any reasonable business at a price so low that the discount itself provides protection. A mediocre business bought at a big enough discount can be a better investment than an excellent business bought at full price. This concept challenges modern investing wisdom that focuses on quality and growth. Graham would argue that paying premium prices for quality or growth eliminates margin of safety and transforms investment into speculation on those qualities persisting and being fully reflected in future prices. He'd rather buy a decent business trading at half of conservative value than a spectacular business trading at twice optimistic value. The margin of safety principle applies to portfolio construction as well. Diversification provides margin of safety by ensuring errors in individual securities don't destroy your overall portfolio. Maintaining a bond allocation provides margin of safety by having stable securities when stocks plunge. Avoiding excessive debt, margin, provides margin of safety by ensuring you won't be forced to sell in a crash. Graham addresses how to calculate the margin of safety for stocks. Compare the purchase price to intrinsic value based on earnings, assets, or both. For bonds, examine the coverage of interest payments by earnings. The greater the coverage, the larger the margin of safety. For any investment, ask, how much can go wrong before I lose money? The more room for error, the greater the margin of safety. The author explains why margin of safety is both effective and difficult. It's effective because it protects against the numerous things you cannot control or predict, economic recessions, industry disruptions, management mistakes, accounting errors, and your own analytical mistakes. It's difficult because it requires patience to wait for genuine bargains and courage to buy when assets are cheap because circumstances look terrible. One of Graham's most powerful insights: seeking safety by buying safe securities at full price provides no real protection. A highly rated bond trading at fair value offers no margin of safety. If anything goes wrong, you suffer losses. A stock of a safe company trading at high multiples offers no margin of safety. If growth disappoints even slightly, significant losses occur. True safety comes from the gap between price and value, not from the inherent safety of the security itself. Graham acknowledges that genuine bargains, securities offering substantial margin of safety, are not always available. Markets can remain overvalued for extended periods. His advice: be patient and hold cash until opportunities arise. The intelligent investor doesn't force investments when nothing offers adequate margin of safety. Cash is a position, and sometimes it's the best position. The chapter concludes with Graham's observation that margin of safety is the difference between betting and investing. When you bet, you accept that you might lose your entire stake in exchange for potential gains. When you invest with margin of safety, you structure the investment so that serious loss is unlikely regardless of what happens. This asymmetry, limited downside with substantial upside, is the essence of intelligent investing and the reason why margin of safety is the central concept. Chapter 6, Practical Lessons and Timeless Wisdom. In the final section, Graham provides practical advice and timeless principles that synthesize his investment philosophy into actionable guidance. First, Graham addresses market forecasting. Don't do it. The intelligent investor doesn't try to predict what the market will do next month, next quarter, or next year. These predictions are unreliable and distract from the real work of analyzing securities. Graham points out that if you spend time trying to predict markets, you're acting as if markets can be predicted reliably, which they cannot. Your energy is better spent analyzing individual securities to find those offering margin of safety. Second, don't take the market's short-term judgment seriously. Graham emphasizes that the market is a voting machine in the short term, reflecting popularity and emotion, but a weighing machine in the long term, reflecting actual value. Daily, monthly, or even yearly price movements tell you nothing about whether you've made good investment decisions. Only long-term results matter. Third, know yourself and choose the appropriate investment approach. Graham's defensive versus enterprising framework isn't about skill levels. It's about interest, time, and temperament. Many highly intelligent people should be defensive investors because they lack interest in analyzing securities or the emotional stability to act independently. Many people of modest intelligence can be successful, enterprising investors if they're genuinely interested and disciplined. Choose the approach that matches who you actually are, not who you wish you were. Fourth, the importance of continuous learning. Graham emphasizes reading annual reports, studying financial history, and learning from both successes and failures. The intelligent investor is always improving their understanding of business valuation, market psychology, and their own behavioral tendencies. Investment is a field where experience and learning compound over time. Fifth, Graham addresses the relationship between investors and advisors. He's skeptical of most investment advice because advisors' incentives rarely align with clients' interests. Advisors are paid to keep clients active and generate transactions, not to maximize clients' wealth. Graham argues you should either manage your own investments following defensive principles or be extremely selective in choosing advisors, prioritizing those with long track records, transparent fee structures, and philosophies aligned with intelligent investing principles. Sixth, the risk of following the crowd. Graham observes that the crowd is usually wrong at market extremes. When everyone is bullish and buying, prices are highest and prospective returns are lowest. When everyone is bearish and selling, prices are lowest and prospective returns are highest. The intelligent investor must be prepared to stand apart from consensus, which requires both intellectual independence and emotional fortitude. Seventh, Graham discusses the role of luck. He acknowledges that short-term results are heavily influenced by luck. Even sound strategies can underperform for years, while poor strategies occasionally succeed. This is why he emphasizes long-term results over short-term performance. Over extended periods, skill and process dominate luck. But you must be patient and disciplined enough to see strategies through inevitable periods of underperformance. Eighth, the danger of extrapolating recent trends. Graham warns against assuming recent market behavior will continue indefinitely. High returns in recent years don't guarantee high future returns. Often the opposite, as high recent returns create overvaluation that reduces future returns. Low or negative recent returns often create undervaluation that enhances future returns. Your decisions should be based on current valuations and fundamentals, not recent performance. Ninth, Graham addresses the importance of independent thinking. The intelligent investor develops their own judgment about security values rather than accepting market prices or analysts' opinions as truth. This doesn't mean being contrarian for its own sake. It means doing your own analysis and acting on your conclusions even when they differ from consensus. 10th, the value of business perspective. Graham repeatedly emphasizes thinking like a business owner rather than a stock trader. Ask yourself, would I want to own this entire business at this total valuation? Is this business earning adequate returns on investment? Are prospects favorable based on business fundamentals rather than market sentiment? This perspective prevents many of the emotional mistakes that destroy investment returns. The book concludes with Graham's reflection on what makes an intelligent investor. It's not brilliance or insider knowledge. It's the combination of sound principles, emotional discipline, and patience. The intelligent investor isn't trying to beat others. They're trying to avoid beating themselves through speculation, emotion, and following the crowd. They understand that getting rich slowly through patient, value-focused investing beats getting poor quickly through speculation, and that protecting capital is more important than chasing every opportunity. Graham's final message: successful investing isn't about finding the next big winner or predicting market movements. It's about consistently applying sound principles, understanding business value, demanding margin of safety, managing emotions, diversifying adequately, and maintaining appropriate balance between risk and return. These principles worked in 1949 when the book was published. They work today, and they'll work for generations to come because they're based on human nature and business fundamentals which don't change. We've journeyed through Benjamin Graham's masterpiece, exploring the principles that have guided the world's most successful investors for over 70 years, from distinguishing investment from speculation to managing emotions through the Mr. Market framework, to defensive and enterprising strategies, to the central concept of margin of safety, to practical wisdom for navigating markets. The beauty of Graham's approach is its timelessness. These principles aren't tricks or hacks that stop working once everyone knows them. They're fundamental truths about how value works, how markets behave, and how to protect yourself while building wealth. They worked in 1949. They worked through the dot-com bubble. They worked through the 2008 financial crisis. And they'll work through whatever comes next. Warren Buffett read this book when he was 19 and said it changed his life. He built a net worth of over $100 billion following Graham's principles. That's not a coincidence or luck. It's the power of intelligent investing compounded over decades. Here's what I want you to take away. Investing successfully doesn't require predicting the future, following complex strategies, or having insider information. It requires understanding value, demanding margin of safety, controlling your emotions, and having the patience to let sound principles work. These are learnable skills, not innate talents. Your action steps. First, honestly assess whether you're investing or speculating in your current holdings. If you can't explain the intrinsic value of what you own, you're speculating. Second, decide whether you're a defensive or enterprising investor based on your genuine interest and temperament, not your ego. Third, for any new investment, calculate the margin of safety. If there isn't a substantial discount to intrinsic value, don't buy it, regardless of how much you like the company. The most important lesson, you're not trying to beat everyone else. You're trying to achieve satisfactory long-term results while avoiding serious mistakes. Graham's approach isn't about spectacular short-term gains. It's about steadily building wealth through sound principles consistently applied over decades. That's how real wealth is built, and that's what intelligent investing achieves. If this summary showed you a better way to think about investing, let me know in the comments what principle resonated most, or what changes you're going to make to your approach. And if you want the complete depth of Graham's wisdom with detailed analysis and examples, pick up The Intelligent Investor. It's dense and challenging, but it might be the most valuable investment book you'll ever read, because it teaches you not just what to do, but how to think. Until next time, remember, the intelligent investor isn't the one who makes the most money fastest. It's the one who avoids losing money while steadily building wealth through sound principles consistently applied. Mr. Market is there to serve you, not instruct you. Demand margin of safety in every investment, and focus on business value, not market prices. Follow these principles, and you're on the path that has created more investment success than any other. Thank you for watching.